Somebody handed you a number. Maybe your CPA ran it. Maybe you found a calculator somewhere on the internet. Either way, it told you that electing an S corporation status would save you $12,000 a year. Wonderful. So you did it. You ran payroll. You made the election. You now pay yourself a salary. You file a second tax return every year that you never used to have to file. And now when the bill comes, it still lands hard. You look at it and you honestly can't tell if that $12,000 ever even showed up. So let's talk about where that $12,000 came from. A calculator asked you exactly two things: what your business makes and what you're going to pay yourself. Two numbers in, 12,000 out. Great. Easy peasy. Unfortunately, your real answer is going to depend on a lot more than just those two numbers. Today, we're going to walk through the ones that matter the most. And if any of them describes you, your S-Corp is probably saving you a lot less than you were promised. So let's build out our taxpayer so we have somebody to run this on. Not a client, just an illustration. Every figure that we're going to use is going to be from the 2026 law, which is current. Now this taxpayer, he's got a job. He's got a W-2 job. It's currently paying him $190,000 a year. He's also got a consulting business on the side that's going to net $150,000 in profit. Now hold on to both of those. He has two of the conditions we're about to walk through. Most of you will probably have one, but we'll come back to it. So let's run that calculator first. As a sole proprietor, the $150,000 is going to get hit with self-employment tax, the dreaded FICA. Net earnings come to about $138,525, and at 15.3% FICA taxes, that's $21,194. That's a lot of tax. Covers Social Security, Medicare. That's the big tax bill that people see when they have a sole proprietor. So he elects for the S-Corp. He pays himself a reasonable salary of $60,000. Great. Now only the salary is going to carry the payroll tax, and that's about $9,180. That other $90,000 of profit is going to come out as a distribution carrying no payroll tax. So he has now saved $12,014. Great. Now let's look at what that formula actually asked him. His profit, his salary. That's the whole questionnaire. Now let's dive deeper to see what it actually left out. Condition 1, you have qualified business income. If your taxable income sits under the threshold, which for a married couple in 2026 is a little over $400,000, this one is for you. The qualified business income deduction, also known as QBI or the 199 Cap A deduction, lets a pass-through owner deduct 20% of business income. Now, as a sole proprietor, essentially all $150,000 of his profit is going to qualify. After the self-employment tax adjustment, his deduction runs about $29,598. That's a great deduction. But now he elects for the S-Corp, and he paid himself the $60,000 in W-2 wages. W-2 wages are not qualified business income. They're just an expense. The $60,000 just left the base. So did the $4,590 of employer payroll tax the company paid on top of it. Business income drops to about $85,410, which means his deduction drops to $17,082. He moved $12,500 of deduction off his own return by electing S-Corp. At a 24% margin, that's $3,000 of tax he didn't owe before. Now, none of that is going to be in that calculator. The election didn't just change the profit gets taxed. It shrank the deduction that's sitting on top of it. Condition 2. You've got W-2 wages from somewhere else. Now, most new business owners start a side hustle while they're currently employed until that side hustle can replace enough income for them to actually quit their main job. Or maybe they just want to double the income, so they're going to run the separate side hustle while still being employed elsewhere. Basically, anything that already has wages landing on your return is going to be an issue. So now let's go back to our taxpayer. Our taxpayer has a job paying $190,000. Great. In 2026, the Social Security wage base is $184,500. Now that's the ceiling. Beyond it, you stop paying the 12.4% Social Security piece entirely. Only the 2.9% Medicare piece keeps going, and that one doesn't have a ceiling at all. His job pays $190,000. So by the time the side business earns a single dollar, his FICA is already maxed out. If the calculator didn't include this other W-2 job, it was already wrong out of the gate. As a sole proprietor, he was never facing a 15.3% tax on the $150,000. He was facing 2.9 plus additional Medicare once the combined income clears $250,000. Added up, and his real self-employment tax was about $4,724, not $21,000, $4,724. The savings he was promised was mostly a Social Security tax that he was never actually going to pay on his new business. As I said, the calculator was wrong straight out of the gate. And then it even gets worse, because now we look at what electing is actually going to cost him. He pays himself $60,000. The company withholds his half of Social Security, $3,720. His day job's withholding on its side too. Between the two employers, more Social Security tax came out than the law requires. So he gets to claim back his excess. On his return, he gets to claim it back as a refund of $3,720. His company does not. The way it works is that your FICA taxes, your Social Security and Medicare, are split in half. You, the employee, pay half, and the employer pays half. The S-Corp paid its own 6.2% on that same $60,000. So again, another $3,720. And there's no way to get it back. The IRS is explicit about this. When somebody works two jobs and combined wages pass the base, the employee claims the excess. The employers don't. Each company is separately on the hook for its share, and neither one gets any relief. That $3,720 buys nothing. It doesn't increase the Social Security. It doesn't go above the cap. It isn't refundable. It's gone. You just gave the IRS a free tip. Every year, this will go on for as long as he keeps this structure, having two W-2 jobs. Now run the comparison honestly. Sole proprietor, $4,724. S-Corp, after his refund, $5,460. Electing cost him $736 more than doing nothing. He should have been a sole proprietor. Whether or not either condition is you, an S-Corp is not going to be free to run. There's going to be compliance. First, Form 1120S has to get filed by March 15th. Not by a CPA, you can do it on TurboTax. TurboTax charges about $1,500 just for the business return, and that's probably going to be about your floor. A CPA that specializes in S-Corps is going to run you a little bit more. You also need to run payroll. Using a service out there, you're probably looking at an additional $50 or $60 for that service, so call it $660 a year. And then you need real books. A Schedule C filer can usually get away with keeping a spreadsheet or a Google Doc. An S-Corp actually needs a balance sheet with basis tracking, retained earnings, distributions, which means QuickBooks or probably something similar. So let's add another $50 a month. You're now at $2,760 a year into your S-Corp election before you even started getting any savings. And if that number you were quoted didn't include that information in it, your break even is now even further out. So why does that first number keep getting quoted? Why do keep people telling you to elect into S-Corp to save thousands and thousands of dollars? Go look at who publishes these calculators. Formation companies, payroll providers, online filing services, CPAs that want to charge you to convert to an S-Corp. The tool that tells you to elect is almost always sold by somebody who gets paid when you do. So just keep that in mind. The calculator told him he would save $12,014. In reality, he's down $6,500. As an $18,514 difference. Same business, same profit, same election, nothing changed except we ran the real numbers. So here's the question that actually matters. If this is true, and it is, why does nobody actually catch it? Because of where the tax gets reported. When you're a sole proprietor, your self-employment tax runs through your Schedule 2, line 4 of the current 1040. It also lands in your total tax. It is all right there for you to see on a normal 1040 tax return. Now, when you're an S-Corp owner, your payroll tax isn't on your 1040 anymore. It's not your half and not the company's half. Your half is going to be on your W-2. The company's half sits on a payroll return and an expense line item in your books. Neither one is actually going to touch the total tax line of your 1040. So, come next April, our taxpayer, he opens up his return, he looks down at the total tax line, and it went down. Maybe not by the $12,000 he was promised, but it went down nonetheless. Success! In reality, though, it went down by roughly the self-employment tax that used to be sitting there. So even though that was still getting paid by you, it's no longer a clear line item. His return will tell him, congratulations, the S-Corp worked. It's telling the truth about the form, but it's lying about the actual tax. And this is why this survives. Not because the math is hard, because the one number you check it against can't show you what went wrong. Now, the honest part, because none of this is an argument against S-Corps. I love S-Corps. If neither condition is you, if you got no outside wages and your profit sits well above a defensible salary, the election works. The 12.4% is generally in play and the savings are real. You still owe yourself the QBI adjustment and the compliance cost, which we were figuring about $27.60. Both of those are going to push your break even higher than you expect, so make sure you're going to account for them when you run these numbers. But it works, as corporations can be a great tax savings vehicle, and for a lot of owners, it works really well. The actual trap is specific. It's the person with a job and a business on the side, the consultant who keeps that salaried role, the physician with a practice, the engineer with a product. That person gets handed a savings number built on a tax they were never actually going to pay, and then hands their own company FICA taxes that nobody can recover. The question was never at what profit does an S-Corp start paying off. The question is, which of these is true about you? Two numbers can't answer that. You need a lot more than just your profit number and your reasonable compensation number. Now, if you want this run properly on your situation, we'll do it. There's a link below to schedule a call with us. We'll happily talk you through all these different conditions and your savings amount. But before you do anything, go pull out the W-2 from your other job and look at box 3. If there's a number sitting at the wage base, you already know your savings may not look as good as you were promised.